This is the Investor Connects podcast series with Hall Martin, episode number 31, an interview with Saurabh Khetrapal. In this episode, Hall Martin interviews Saurabh Khetrapal, and the discussion centers around how to value and assess the businesses to invest in, as well as how to negotiate terms. And there's a couple of key items here. One is the key concept of what he calls the deal rights, which can be evaluated all over again for negotiation. And also, he talks about humility. The term humility in a situation where maybe when the business founders are a bit wrong or when they're mistaken, as well as when they're right, and it's a key attribute that he looks for. So in this episode, Hall investigates the terms that are included in his deals, not only reading the documents or maybe having an attorney read them for you and explain them for you, but also for the economic facts of the deal, what he calls the deal economics. And then after the seed investment, what kind of deal rights will be evaluated all over again for negotiation. And finally, what does he mean by the most favored nation clause in the weighted average? It's all very key here in this episode from someone who's been on both sides of the deal. He's been an entrepreneur for 20 years with 3 startups, but has also been helping entrepreneurs with guidance and experience. So let's listen in as Hall Martin leads this interview in a very interesting discussion about humility, deal rights, and deal economics, especially how to value and assess the business that you're going to invest in, as well as negotiate the terms. So let's listen in.
Well, thank you, Saurabh, for joining us today. I wanted to talk more about your experience as an angel investor and what you look for in deals. And you mentioned in our last meeting you had certain criteria you put into deal terms that sounded pretty interesting, and wanted to talk about that as well. Can you tell me a little bit about your angel investing experience, what you've done so far, and what you look for when you find new deals?
Sure. Thanks, Hall, for this opportunity to share my thoughts on angel investing. I actually come from both sides of the deal table, if you will. I've been an entrepreneur for 20 years, did 3 startups as a founder. In all 3 of the startups that I founded or co-founded were based in Silicon Valley. And then I've been also on the other side where I come in as an investor and help entrepreneurs, not just by writing checks, but also by providing guidance and sort of digging into my chest of both positive experiences as well as scars as an entrepreneur to help them. So, I've spent 20 years in Silicon Valley as an entrepreneur and an angel investor. 3 years ago, we moved to Austin, Texas, and I've been fairly actively investing in mainly tech startups here in the headquartered in Austin. So, my angel investing started in 2000, right before 2000, actually. I made my first angel investment in 1999, and so I've been at it for a good 17, 18 years. Majority of my investments skew towards technology companies, and if we were to narrow that down even further, I have a strong penchant and affinity for B2B technology companies, software companies. That's been my background as an entrepreneur in B2B, software technology, and that's the area I know best. So it was natural for me to find deals that are in that space to be the most attractive and deals that I can contribute most meaningfully. So, I've been doing it for 18 years with a mixed bag of success, good and bad. So in terms of what I look for, and we'll get into some of the deal terms that you had alluded to earlier, but what I look for, the overarching criteria during my diligence is really the entrepreneurs or the founding team. They really make or break the business. Obviously, we also look for, I say we as in I invest out of our family office, so besides me, there are other stakeholders that also are part of the diligence process. So we look for, obviously, the market opportunity, the total addressable market, the business moat or the unique selling point, IP, etc., that the company or the entrepreneurs have carved out for themselves, the traction and early proof points that they have been able to drum up. But overall, I think, if you talk to almost every angel investor, and everybody has their own sort of weighting criteria in terms of how much they weight one aspect or one factor over the other. But I would say majority of the angel investors really put a lot of weightage behind the entrepreneurs or the founding team, and that, I'm no different.
When you look at a team, what exactly are you looking for? What skills or what qualities that you find separate the ones you want to pursue versus those you don't with the team itself?
That's a really good question. And the reason I say that is because the answer to the question is a very difficult answer, because an entrepreneur must have certain personality traits, certain experiences, good and bad, and a good entrepreneur should have all of that in spades. I'm talking about personality traits and good and bad experiences. So let me get into the personality traits first. One of the things that I really am big on is humility. I think that hubris and ego are some of the most toxic elements to any kind of relationship. And when we talk about entrepreneurs, we're talking about relationships with your employees, with your co-founders, with your clients clearly, with your shareholders, with your partners, with your suppliers, with your business development associates. So as an entrepreneur, as a founder, if you don't have what it takes to build relationships, to bring in talent, to bring in clients, to bring in money, investors, to bring in business partners, to bring in vendors, you really can't do this on your own. So it's all about relationships. And I think that one of the cornerstones of successful relationships is humility. The ability to say sorry when you know you're wrong. First of all, the ability to recognize that you did something wrong or you made a mistake. And then to have the humility to say sorry, and also to have the humility to say thank you. And having also and then humility obviously translates into many good things, such as coachability, such as nimbleness, understanding that the strategy or the tactics or direction that you thought you're going to take this company needs to pivot in order to take maximum advantage of the opportunity. So it takes a certain amount of humility and a certain amount of self-recognition to be able to pivot and say, hey, you know what, I thought this is what the opportunity is, but guess what, I was maybe a little bit wrong, let me tweak it. So I think that's huge for me, humility. Obviously, you want to have someone who works hard, who is intelligent, just smart, and has excellent communication skills. Communication skills from a perspective of listening and speaking and communicating out when appropriate, and just keeping quiet when it's time to be quiet. So listening is very, very important, but obviously being able to articulate yourself at the right time with the right amount of words is also very, very key. So, but I really put humility right up there. And when we talk about entrepreneurs, especially those that have successes, that tends to be, hard to find. Somebody who has been successful, someone who knows their intelligence, somebody who knows they're sitting on a great opportunity in terms of a company or an idea, and then to have, the modesty or the humility to say, you know what, I'm going to keep my feet on the ground, not think that, I'm all that. So, yeah, so in terms of personality, that's what I look for, and coachability is very, very important. And besides that, somebody who can build teams, but all the things that I described earlier are key components to someone who can build good teams. Someone who is intelligent, hardworking, can lead by example, can communicate, and can build good relationships. So that's what I look for in entrepreneurs.
Well, that's great. Humility I found is really key in just the interpersonal workings in the team members themselves. A fair number of companies go under not because the market took them out, but because they took each other out.
Right.
And if you have some humility, that tends to foster better working relationships, and you don't self-implode. You now can face the competition and the work that has to be done. So it's a key element as well. But now why don't you tell us a little bit about the terms you put in the deal, because I found that was kind of interesting. I think a number of investors just go with the flow. Whatever's in everyone else is doing, that's what they do. But if you have some experience with angel investing, you realize that there are gotchas in these term sheets, and there's things that you can do to improve your returns. And so what do you look for in term sheets, or what do you ask for that's maybe not just what everyone else is doing?
First of all, when you say a lot of angel investors go with the flow, I see that, and I'm quite frankly shocked how many angel investors don't even read the documents that are the linchpins, and understand what they're signing. So first of all, I would tell every angel investor, if you don't have the experience or the time to read the documents, get a really good attorney to do that for you. And I can guarantee you, it may pinch a little bit to pay a couple $1,000, $3,000 to get someone good to spend a few hours on reviewing the documents, but that will pay back dividends like nothing else that you would invest. You're right. There's so many gotchas now. So the first piece of advice would be just definitely read the documents that you're signing, or get a good attorney, a securities lawyer to go through those. Now, in terms of the terms I look for, obviously you have the deal economics, right? You have the price of the share. In a convertible note situation, you have discount on the conversion, the valuation cap, warrants, if that's what some of the deals have included in them. So deal economics are obviously no-brainer. You have to make sure you get the best. Obviously, when I say get the best does not mean beat up the entrepreneur to the point that they are completely demotivated and hate you. At the end of the negotiation, they'll take your money, but they hate you. But get the best deal economics that both parties can feel good about, and feel a little bit of pinch as well. You feel as an investor that you've given up enough, but you can live with it. And the entrepreneur feels the same way. That, maybe I didn't get everything I wanted. I gave up a little bit more than I would have liked to, but I can live with it. I feel pretty good. But besides the deal economics, there's a couple of things that I look for. And before I say what I look for, let me preface this by saying that whatever angel investors try to negotiate in terms of the deal terms or rights or whatever it is, it's largely an illusion. And the reason I say that is because if the company is going to go out and raise another round, an institutional round from a venture capital firm, everything that you negotiated as an angel investor in the prior financing is going to be up for negotiation all over again. So just because you have a seed investment as an angel investor, you come in and you put a seed investment in, and you negotiate certain deal terms or rights or what have you, don't think that they are, untouchable rights. They're going to be construed by any future financing lead, usually a VC firm or a much more sophisticated investor than most angel investors are. And, you can sit there and throw a hissy fit and say, I'm not giving up these rights, or I'm not giving up these preferences, or whatever it is. But then, they say that the man with the gold controls the situation, right? The person who's going to lead them, the person who's bringing in the money in the future financing is going to dictate the terms. And if you don't like it as an angel investor or as an earlier investor, you can actually sink the company. So having said that, a couple things that I look for is something called most favored nation clause, most favored nation clause. And a large part of the most favored nation clause is the anti-dilution. Now, anti-dilution is something that's not new, and anti-dilution comes in a couple different flavors. You have the full ratchet anti-dilution, which is very draconian to the entrepreneur, very aggressive, or you have the weighted average anti-dilution method. But some kind of anti-dilution should be part of what I call the most favored nation clause. But my most favored nation clause goes a little bit beyond the anti-dilution. And what I look for is if a subsequent investor comes in after I put my money in and gets better rights or better deal terms than I have, or better preferences than I have, then I would like to have the right or the option to get those same kinds of benefits or rights and preferences and terms. So that's a most favored nation clause. I always like to have some kind of right to information provision. May not be all the information, but I do want to have right to information, some of the key information about the company. And then obviously this is something that's pretty par for the course, but pro rata rights, which is, the right to participate in future financing on pro rata basis. That's something that I look for, and that's, I think, sort of par for the course now.
So for the information rights, what rights are you looking for that don't normally come with standard investor information rights? Are there key information you're looking for that not other people get, or how is that different?
One of the things that, first of all, when you see standard information rights, there's nothing really standard now. I've seen all kinds of flavor all over the map. And just having, lived a big chunk of my professional life in Silicon Valley and now being in Austin, even the two places have very different sort of flavors of term sheets. Obviously, you have the same sort of common denominator, but once you dig in a little bit deeper and peel the layers of the onion, they look very different. So I don't know what standard information rights really mean, but from my perspective, I obviously, first of all, I want the contact information of all prior investors and new investors. That's something that a lot of entrepreneurs don't automatically feel good about. They sort of want to keep all their investors separate in silos, not facilitate or even want communication. Maybe they're afraid of collusion or some kind of other, nefarious things that investors may do if they were to collude together and be able to communicate. So information rights is information about all key investors and key officers and founding team members, obviously. And then obviously financial information. I would like to get, I'd like to get, copies of, board meeting minutes, whatever they, whatever the agenda and material might be part of any board meeting. So that usually includes, financial information. Now, obviously, some entrepreneurs may say no to that. Some may be okay with it. But I'm giving you my wish list, right? I mean, and then that's our starting point, and then we can see, depending on who the entrepreneur is, how much experience they have, what the board consists of, etc. I always negotiate up or down from this, what I'm describing to you. So that's what I'm talking about in terms of information rights. Contact information as well as financial information and any kind of documents coming out of board meetings. So.
Right. Well, I found that contact list or investor list pretty common among family offices. With angels, it tends to be come one, come all, the more the merrier, pile on in here. With family offices and other, investors, they look very hard at who's in the deal or who may be in the deal, and they make a lot of decisions based on that, based on past experience or based on the direction they want to take the company versus what other investors may want to do. And so it is a key question to know who else is in the deal and what direction they might want to go. So that's certainly a good one to have for as well.
Not just that. What happens is, as you know, a lot of early stage investments now, especially seed, are having convertible notes, right?
Right.
And it's not uncommon for those convertible notes to go into default, as in they mature, the notes mature. So I've been in a situation where a note has matured, and I'm one of the investors that came in as a convertible note holder, but I have no idea who other note holders are. So I don't know what to do with this now, note that's in default. Now, if I had the contact information of my cohorts and my sort of other people that are in the syndicate, right, I could have called them and say, hey, what are we going to do about this, right? Can we get together and figure out, should we convert? What do we do, right? But not having that information of my co-investors in this convertible note leaves you in a lurch. You don't know what to do.
So what were the other terms you look for in these deals?
It's fairly common now, but for convertible notes, speaking of, usually the convertible notes that I've seen here in Austin, and obviously there are exceptions to everything, is usually here's the conversion trigger. The financing event is going to be, say, a minimum $1 million of new money coming in an equity round that converts the convertible note holders' investment. Here's the valuation cap, and here's the discount. What I like to see is more of a time-based schedule of discount. So if the conversion happens between 0 to 12 months, the conversion will be 20%. If it's 12 to 24 months, it'll be 30%. Because what's happening now also is a lot of companies are really, really pushing back their A round. Because, if you're a successful company, it's not infeasible to really go quite far with your seed investment of, say, $1 million or $750. It can take you fairly far. So if I come in and I have a val cap of, say, or a discount of 20%, and the company doesn't raise another round for, say, 3 years, now the val cap may hit. But generally, most angels don't really spend a lot of time negotiating val cap. Val cap is sort of the reason we do convertible rounds, because you don't want to get into valuation. And if you start negotiating a val cap, it just defeats a large reason to go to convertible notes. You might as well do an equity round, right? So, I've seen convertible note term sheet that say a 20% discount with a $10 million val cap. And I don't really spend much time, or I haven't seen many angels negotiating the $10 million val cap, because I'm saying, if they raise another round in, say, 16 to 18 months or 12 to 18 months, maybe they'll get $6 million pre, I get 20% discount, I'm happy with that. But if they don't raise another round, if the conversion event, if the qualified financing does not happen for 3 years, it's not inconceivable that the valuation of that equity raise 3.5, 4 years hence from your investment may be $12 million. And you converted $10 million pre-money, and you've been sitting on this earning 4%, 5% interest for 3-4 years, and you get a conversion at $10 million. It just doesn't make sense, right? So for convertible notes, I like to have a time-based conversion schedule, depending on when that qualifying event or when that qualified financing happens.
Well, we often are seeing more performance-based metrics inside of term sheets, and this is kind of in that vein where the entrepreneur performs to a better degree, they get to keep more of the company. They perform
Right.
to a lesser degree, well, the investor is putting that burden on them and it's costing them. And where I've seen it come out is people that are negotiating valuations will say, okay, you want a $10 million valuation, and next year you're going to have $2 million of revenue. Well, okay, we'll do that, but if next year you only have $1 million of revenue, that $10 million valuation is going to pull back to $8. and therefore you're taking the risk, Mr. Entrepreneur, for achieving that valuation. But up front, I'll agree to it, but later I may claw back some equity for not achieving it.
Right. But you're talking about a price equity round, right? I mean,
in that case, it's a price equity round, but you're doing a performance metric on, based on time. How long am I sitting in this convertible note before it converts over?
Right.
And it's a little different, but it's also, in some sense, a performance-based thing as well. And that's just my terminology for it. But you start to see, people putting in what-if scenarios in the term sheet to cover things that may not go as proposed or planned. And, of course, they rarely go as proposed or planned. And so now the entrepreneur has to make the decision, do I take this term sheet with these metrics in it that might cost me in the future? And in some cases, they do that, of course, because they need the money.
Right. And like I said, Hall, I mean, all of these things are not guaranteed. I mean, some of the rights that I look for, information rights, most favored nation, anti-dilution, things of that nature. I mean, down the road, if the company raises another institutional round, the VC may come in and squelch most of them. But at least it gives me a seat at the table, negotiating table, right? If it's something that I have in writing, it's part of my sort of term sheet, I may have to give it up because, like I said, the person who controls the goal controls the terms. But at least it gives me a seat at the negotiating table with the future lead investor. So, but I mean, all of these things, that's just how investing works. The early investors try to get the best deal. The later investors try to squelch the previous investors. I mean, that's just how it works. So
he who has the goal makes the rules. So that certainly applies to angel investing as well.
Exactly.
Well, that's good information. I appreciate you sharing that with everybody today. There's a lot of good ideas in there as well about how you value the business and assess the business, as well as how you negotiate the terms. And it's certainly a key element for having a good success with angel investing. But any closing thoughts you would like to add that you haven't covered already?
No, I mean, I think that the last thing I would say is that all angel investors should have reserves, because besides having whatever term sheet that you have and the rights you have negotiated, if you're one and done, term sheet that you have and the rights and the agreements that you have in hand based on the investment that you have made may get you a seat at the table. But if you're not participating at the future financing and bringing in some of the gold, you're completely naked. I mean, you're completely vulnerable. So the last piece of advice I would say is always have reserves as angel investors, because that will give you a little bit more leverage to get the deals, get a good negotiating position. And even if you have to give up some of your rights and terms in the prior round, if you're investing alongside of the institutional investor in the A round, in the B round, in the C round, you may make up for what you have given up in your seed round with terms that you have gotten in the subsequent round. So always keep some treasure and some dry powder ready to invest in future rounds.
That'll certainly separate you from the crowd, who usually don't have anything left, and they're just at the mercy of what's going to happen at the time. So if you have more money to put in, then you really do have a lot of choices there, as far as he who has the goal makes the rules, and in those particular times. Well, very good. Well, thank you so much for sharing your information today, and we'll put this together and put this out to the community, and I think we'll find a lot of people very interested in your thoughts there as well.
Thank you, Hall, and thank you for everything that you're doing for the entrepreneurship as well as investor community in Texas. Thank you so much.
You're welcome.